Debt is still a four-letter word, particularly when it comes to sovereign debt right now. There's still fears about the levels, particularly of Irish debt out there. Right now, their budget deficit's at 33% of GDP. Irish Finance Minister Brian Lenihan is here in the U.S. trying to talk to investors to say they can handle these tremendous expenses without having to go and ask for emergency funds from the IMF or from another fund in Europe. But he did say quite candidly, if Ireland hadn't been part of the Eurozone, they might have had a situation like Iceland did. We had a broad conversation earlier today. I was excited to get to talk to him, and we started off with why he's so certain Ireland won't need outside financial help.
The first point you have to do is look at the real Irish economy. We are exporting. We're not in a balance of payments deficit position. Our exports have retained a lot of their strength throughout this recession. We're emerging from recession with strong export performance, but we do have real fiscal and banking problems to address. We are addressing them, and we have a plan to address them. On the banking, as you know...
Despite the stronger euro there and then the contraction that did just happen with the Irish GDP.
We had a big contraction last year in 2009. We contracted by 10% in GNP terms in 1 year. We've got it back to zero this year, and that's quite a turnaround to go from 10% to zero in the space of 1 year. We have to take the necessary measures on the banking side. We've done that. We've differentiated the different institutions. We've made it clear what the cost is going to be, and we're averaging that cost over a 10-year period. On the other front, on the budgetary front, clearly we have a big challenge there because government receipts are lagging well behind government expenditures. We've already done a correction of 7.5% of our GDP, and we're now about to publish in November a four-year plan which will outline how we can get growth and how we can correct our budget over a four-year period. And the first instalment of that will be in the December budget.
A lot of anticipation about that budget. I know you were at the IMF meetings over this past weekend. You were quoted there in the press as saying that there will be above €3 billion in spending cuts and tax increases for 2011. Where is that money coming from?
Well, again, you have to look at your expenditure base, obviously, and decide what expenditures can be reduced. We've already reduced public service pay in Ireland by nearly 14% on average. We're much bigger, of course, for ministers and much less for those in clerical and other positions in the public services. Likewise, we've looked at our welfare bill. We have to look at our pensions bill. We have to look right across our capital investment projects. All of these areas have to be looked at. They're on the table. And what we're going to do is demonstrate over a four-year period how we can make those adjustments. Because obviously an adjustment on this scale can't be done in 1 year. It will be averaged over 4 years, combined with a strategy for growth, looking at the supply side in the different sectors. We've retained a robust export sector. We have to continue to develop our traditional sectors as well. And we can do that. We have a strong underlying economic base. We had a big property bubble earlier in this decade, and that has had a big impact on the economy. We're working out the consequences of that.
You're emphasizing their cuts. Does that mean that tax increases, how big of a portion are they going to be in helping to close this?
Tax will have to play some part in terms of base broadening, increasing the numbers who are in the tax base. At present, a lot of earners are not in the income tax base in Ireland, but I do want to make it clear that the corporation tax of 12.5% will stay intact. That is our industrial investment policy, and we're sticking with that.
So you will not move that higher than 12.5%?
No, we won't. No, because
do you fear corporate flight if that were to happen?
Well, that's the risk, and candidly, we have decided to make this the cornerstone of our industrial investment strategy. We have a lot of companies in ICT, in pharmaceuticals, medical devices, banking services, making a tremendous contribution to the economy. We want to encourage that investment, not discourage it.
Ireland nationalized Anglo-Irish Bank, and they've taken a majority stake in Allied Irish. I was talking to Irish Finance Minister Brian Lenihan about what's going to happen to the bondholders of Anglo-Irish.
In Irish and English law, we still have the position that senior bondholders rank the same as depositors. So were you to apply a haircut, it would have to be applied to depositors as well, and that's just not a viable proposition. Ireland also depends on funding itself in senior debt markets, sovereign debt markets, and of course the other Irish banks that are not troubled and not distressed have to fund themselves in senior debt markets. And there would be immediate right to read through were there any questions about senior debt, which there are not, and all those obligations met in due course.
What kind of appetite are you seeing from U.S. investors or international investors in some of these troubled assets? Where is the interest coming from?
Well, we're not seeing much interest in the troubled assets. We've had to deal with the troubled assets ourselves.
With NAMA there.
We've set up NAMA, which is our
some of the troubled institutions, I should say.
And what NAMA has done is it has gone into the banks and administered very, very sharp discounts, often over 50% on the loan books. And that has left some of the institutions undercapitalised. In the case of two of the institutions, Nationwide and Anglo, they're in total state control, and the state will downsize them over time and eliminate them eventually from the banking landscape or sell them on. But in the case of the main banks, Bank of Ireland, Allied Irish Bank, these banks continue to be listed on the stock exchange. Bank of Ireland raised money in the markets earlier in the year. Allied Irish Bank will probably have a substantial state stake. There's also a building society, EBS, in which some of these investors have expressed an interest. And clearly these bids are welcome. They will be evaluated and worked through by the authorities in Ireland.
Well, investors like Roman Abramovich have been out there prominently and speaking and asking questions about, buying junior Irish bank debt in good faith. And what do you say to someone like him as to taking pain here?
Let's be clear. We are not talking about subordinated bondholders in banks that are listed on stock exchanges. We're talking about subordinated bondholders in nationalised banks, which can only survive with taxpayer support. And it is only in those circumstances that we're examining legislation to postpone subordinated bondholders to the taxpayer, without whose help these institutions would not exist, and not deal with their senior bonds and deposits and honour them.
So the kind of approach you're saying it only really applies to Anglo and to Allied Irish at
No,
this
Anglo
point.
And Nationwide. It does not apply to Allied Irish. Allied Irish is still a listed bank on the stock exchange in Dublin.
Thank you for clarifying that. I want to ask you about the question of political risk out there for global investors, right, who are watching this show all around the world and hearing from you. They can read headlines right now that talk about the approval rating, the Prime Minister being low, questions about the stability of the Irish government here. Talk to me about this new idea of a national government that's been floated there to address the financial crisis.
Well, look, there's no great appetite being shown in Dublin for a national government. My party has suffered a considerable political cost and paid a big political price for making the correct decisions in recent years. And what we will do as a government is publish a 4-year framework for budgets and growth this November. That framework will set out in a realistic way the options that are there for Ireland, and the first instalment of that will be provided for in the budget in December. We have a parliamentary majority to do all those things. As the electoral period approaches in the following year to year and a half, as that period approaches, it is the framework which will focus the minds of all the political parties on what has to be done in Ireland. And the framework is important, not just in showing investors a credible pathway forward for Ireland in fiscal terms. It's important for voters and politicians as well, because it will focus their mind on the actions that will be taken. And I believe that when the framework is published, the political parties on all sides will recognise what the problems are and what the fate that awaits them in government is.
Be sure to watch In Business on Tuesday, 10 and 11 a.m. Eastern Time. Elizabeth Warren, the new advisor to the Consumer Financial Protection Bureau, will be with us. We'll talk to her about financial reform post the congressional elections.